Welcome to ValueBot Studios, where AI-powered insights meet real-world investing. We decode earnings, valuations, and growth fast. No fluff, just what matters. Whether you're short on time or deep in the game, this is your edge. Tap subscribe and let's get into it.
Welcome to the Deep Dive. Today, we're embarking on a mission to understand one of the biggest puzzles in the tech world right now. Now, if you've been following the market, you might have scratched your head a bit recently. And honestly, well, you wouldn't be alone. Apple just reported its Q3 2025 results, and by all accounts, they absolutely soared past Wall Street expectations. Some really impressive numbers. Yet, if you look at the stock's performance year-to-date, it's been significantly underperforming. It's a real head-scratcher, isn't it? So our mission today is to dive deep into this. We're going to unpack Apple's competitive positioning, its real growth drivers, the challenges it's navigating, and, of course, how the market's actually valuing it. We've got the latest financials, a heap of analyst insights, market sentiment. So how do we start to unravel this particular puzzle?
Well, that's precisely the exciting part, isn't it? We get to look beyond the headlines, really understand the nuanced story of Apple. It's not just about those impressive numbers. It's about connecting those dots to what seems like a contradictory market reaction. We'll see how a company can be doing so well financially, yet still face skepticism about its future. It really gets to the heart of perceived value.
Okay, and speaking of stellar numbers, let's kick things off with those Q3 financials. This is for the quarter ending June 28th, 2025. And this wasn't just a good quarter. It marked Apple's 9th consecutive quarter of beating both earnings and revenue forecasts. That's quite a streak.
Remarkable consistency, yeah.
So how good were they exactly? Well, total revenue came in at $94.0 billion.
$94 billion, wow.
Up a solid 10% year over year, and that significantly beat Wall Street's expectation, which was closer to $89.5 billion. And on the profit side, diluted earnings per share, EPS, came in at the $1.57. That's up 12% year over year, also well ahead of the $1.43 expected.
And what's really compelling here is how they got those numbers. That tells us a lot about their competitive strength. The iPhone, still the absolute powerhouse, saw sales reach $44.58 billion.
$44.58 billion?
Yeah, a 13% year-over-year jump. And it accounted for nearly half of their total revenue. Just smashed expectations, which were around $40 billion.
So the iPhone is clearly still the main engine.
Absolutely. Tim Cook, the CEO, he put it pretty well. He said, today, Apple is proud to report a June quarter revenue record with double-digit growth in iPhone, Mac, and services, and growth around the world in every geographic segment.
Double-digit growth across key areas.
Exactly. And beyond the iPhone, services hit an all-time high, $27.42 billion. That's up 13% year over year as well.
And services includes things like the App Store, Apple Music, iCloud.
Right, all of that. It's crucial for their long-term recurring revenue and profitability, too. Oh, and Mac revenue also did really well. It beat expectations at $8.05 billion. So these areas aren't just performing. They're really expanding that whole Apple ecosystem.
It really sounds like a lot of cylinders were firing then.
Definitely.
And it wasn't just revenue growth. Profitability looks strong, too. Gross margin improved to 46.5%.
Yeah, ahead of the expected 45.9%.
Yeah.
Good management there.
And what about geographically? Cook mentioned growth everywhere.
He did. Growth around the world in every geographic segment.
Yeah.
And importantly, Greater China revenue rebounded strongly. Came in at $15.37 billion, topping estimates. That had been a bit of a worry spot for some analysts.
Okay, that's significant. And there was something else. The installed base.
Ah, yes, the CFO, Kevon Parek, he highlighted that. Yeah. Our installed base of Actor devices also reached a new all-time high across all product categories and geographic segments.
This really speaks to that customer loyalty, doesn't it? That sticky ecosystem.
A massive competitive advantage, absolutely. A huge moat.
Right.
But, for a balanced view, we do need to look at the whole picture. There were a couple of areas that, didn't shine quite as brightly. iPad revenue, for instance, came in at $6.58 billion. That actually missed estimates of about $7.24 billion. And wearables, home and accessories, so think Apple Watch, AirPods, that segment also saw a decline, dropped to $7.4 billion from over $8 billion the year before.
So Smaller segments, but still not everything was hitting records.
Exactly. It just reminds us it's not always straight up across the board.
That's a fair point. So with these, let's call them mostly outstanding financial results, let's shift to how the market is actually valuing Apple right now, as of July 31st, 2025. If we look at the valuation metrics, EV to EBITDA, next 12 months, it's at 22.5x.
Correct. 22.5 times. And that's compared to its own 3-year average of 23.3x.
Yeah.
And a recent high of almost 27x.
Okay. And the price to earnings ratio, PE, also next 12 months.
That stands at 28.5x. Again, compare that to its 3-year average of just over 30x and a high of 35x.
So what does that tell us?
But what's really telling is that even after reporting such strong results, Apple is trading below its recent historical averages on both metrics. It suggests that despite the impressive quarter, there's still some, let's call it investor caution or skepticism baked into the price. It's not getting quite the premium it has commanded recently. That's a key part of this puzzle.
Interesting. And yet, when we look at the analysts, the sentiment seems quite positive.
Overwhelmingly so, yes.
The current price is around $207.57, maybe a bit higher after hours. And out of 43 analysts covering the stock, 27 recommend a buy or strong buy. That's a solid consensus.
It is.
And their average 12-month price target is $230.18. That implies what? Nearly 11% upside potential from the current price?
Right. And while the low target is down at $173, the high target goes all the way up to $300. So the street generally sees more room to run.
Okay, so the street's optimistic. What about the internal models from our sources? Do they paint a similar picture?
They generally align. Yeah, maybe slightly more conservative, but still positive. The model suggests a target price around $216.33. And it flags an ideal buy-in price right around where the market is now, about $207.77. What's interesting is the potential range. The upper target is $263.30, which suggests a potential max gain of almost 27%.
That's significant upside.
It is. But of course, there's risk. The lower target is around $155.95, implying a potential downside of nearly 25%. So the risk-reward ratio is calculated at 1.08 potential reward, slightly outweighs the risk according to this model.
And what about efficiency? How well are they using their capital?
Oh, incredibly well. The return on invested capital, ROIC, is just staggering, 56.59%.
56%.
Yeah. For every dollar Apple invests, it's generating over 56 cents in profit after tax. Compare that to its cost of capital, the WACC, which is about 9.12%. That massive spread shows phenomenal capital efficiency.
Okay. And future growth forecasts?
The model forecasts revenue growth around 4.23% and free cash flow growth higher at 9.15%. One thing to note, though, is the beta. It's 1.20.
Meaning it's more volatile than the overall market.
About 20% more volatile, yeah. So it tends to amplify market swings, both up and down.
Okay, so here's where it gets really interesting, connecting all these dots. We have these undeniably strong financials, consistently beating expectations. We have positive analyst outlooks, incredible capital efficiency. And yet, the stock has been down significantly year to date. This disconnect, it has to be about more than just the latest quarter, right?
Yeah.
What is actually weighing on investor sentiment?
This is precisely the core of it. Understanding Apple's competitive position and the challenges it faces. It's a real dynamic interplay, this tug of war between bullish optimism and bearish concerns. These are the key debates shaping how investors see Apple right now.
Okay, let's break those down. What's the first big theme?
First up, let's talk AI. Apple's AI strategy and its innovation leadership, or perceived lack thereof.
Right, AI is everywhere now.
Exactly. So the bullish view is that Apple is investing heavily. They're leveraging their powerful Apple silicon chips, integrating AI features right into the ecosystem, seamlessly. The argument is this positions them well for future growth as smart device demand rises, especially with their massive loyal user base. They point to announcements from WWDC 25, the developer conference, about beautiful new software design and Apple Intelligence features as proof of progress.
Okay, that's the positive spin. What's the counter-argument?
Well, the bearish view expresses real concern about what they see as a slow AI rollout, and they point to losing key AI talent to rivals. Some analysts see Apple as lagging peers like Meta and Microsoft in the AI race, and they argue Apple's approach on-device, privacy-focused AI might be less compelling for driving immediate upgrades or engagement compared to cloud-based AI. And the disappointment over the lack of major AI upgrades to Siri at that WWDC event, that was specifically cited as something that hit the stock price. So a real debate there.
Okay, AI is clearly a major battleground. What's next?
Next, let's look at iPhone sales growth and the product cycle momentum.
The core business.
The core business. So The bullish argument obviously points to those strong Q3 iPhone sales we just discussed. Big driver. There's optimism tied to promotions, new models like the rumored iPhone 16, and that strong demand rebound in China. The expectation here is that upcoming products, maybe a new slim iPhone, M4-powered Macs, will fuel replacement cycles and keep growth going, maybe even above seasonal trends. They believe Apple still has that innovative spark.
Makes sense. But the bears.
The bears are cautious. Some argue those strong Q3 sales might have been demand pulled forward, maybe because of tariff fears, which could mean weaker growth later in the year, maybe below seasonal norms.
Setting up for a tougher comparison.
Potentially. And analysts at Jefferies, for example, have warned that the next iPhone cycle, the iPhone 17, might lack truly compelling new features. They see a risk of flat, maybe even declining unit growth down the line. UBS also predicted some softness for the September quarter, so questions about sustainability loom large.
Okay, so AI uncertainty, questions about future iPhone momentum. What else is weighing things down?
The third critical theme is tariffs and supply chain risk, how that impacts margins, profitability, their competitive footing.
Always a factor with global companies like Apple.
Absolutely. The bullish perspective here is that Apple's doing a good job managing it. They highlight the supply chain diversification efforts, shifting production to places like India and Vietnam to mitigate the China tariff risk. They argue Apple's global management skill and its ability to pass on some costs, especially on high-end devices, helps protect margins. They point to that Q3 gross margin beat as evidence that cost management is effective.
Okay, so they're navigating it. What's the bearish take?
The bearish view frames tariffs as a major persistent headwind. They cite a specific figure, a $900 million impact on quarterly gross margins already, and suggest more increases are likely.
$900 million, that's substantial.
Yeah, it is. The argument is that absorbing these costs is already hidden profitability. And if trade tensions continue or escalate, Apple might be forced into more price hikes, which could hurt demand, or they absorb more cost, hurting earnings. Either way, it threatens their competitive position. And the sources we looked at explicitly cited these trade tensions as a key reason for the stock's underperformance this year. It's like this constant drag.
Right. So putting it all together, AI strategy, iPhone sustainability, tariff pressures, it really is a dynamic tug of war, isn't it?
It really is.
On one side, you have this undeniable financial strength, the ecosystem, the loyalty. On the other, these very real forward-looking concerns that seem to be holding the stock back. This is the core of the paradox we started with.
Precise.
Okay, let's make this even more concrete. How did these themes actually play out in the stock price recently? Say in June and July leading up to the Q3 report. You mentioned volatility.
Yeah, there were some clear examples of how sensitive the market was to news related to these themes. For instance, on July 30th, just before earnings, the stock dropped about 1%. Why? Nervousness, tied directly to trade tensions, worries about AI delays, and maybe softer iPhone expectations than the numbers actually delivered.
So pre-earnings jitters linked to those exact concerns.
Exactly. The day before July 29th, it fell 1.3%. Bank of America reiterated concerns specifically about margin pressures from tariffs and also regulatory challenges. And back in June, you saw dips tied specifically to commentary about slow AI progress, renewed worries about China sales, and that reaction to WWDC being, quote, underwhelming on the Siri AI front.
So negative news definitely hit the stock. Were there positive triggers too?
Oh, absolutely. It wasn't a one-way street. On July 22nd, the stock gained almost 1% because analysts put out positive forecasts and upgraded price targets.
Analyst sentiment moving the needle.
Yes. And on July 2nd, it jumped over 2% in a broader tech rally, but specifically helped by headlines suggesting iPhone demand in China was actually robust.
Contradicting some of those earlier worries.
Right. Analyst buy ratings on July 1st also gave it a boost. And going back to June 20th, news about progress on U.S.-EU tariff negotiations eased some of those trade fears, leading to a nice 2.25% pop.
So each piece of news, positive or negative, relating to AI, iPhones, China, tariffs, it clearly pulled the stock back and forth.
Constantly reacting to those key narrative drivers.
Okay, let's bring it all home then. Despite that strong Q3 beat, despite all the positive financial indicators we discussed, the sources confirm the stock was down roughly 15% year-to-date leading into this. It really highlights that the market isn't just looking at the rearview mirror at the quarterly beats. It's heavily focused on these unresolved forward-looking concerns, isn't it? The competitive landscape ahead.
That seems to be the crux of it. To summarize the core takeaway, Apple is, without a doubt, a financial powerhouse. Massive installed base, incredibly loyal customers, that phenomenal ROIC of over 56% versus a WACC around 9%, just incredible efficiency. Yet the market is clearly discounting these strengths. Why? Because of these specific anxieties we've unpacked. Its AI leadership position, the sustainability of that core iPhone growth engine, and the persistent drag from global trade tensions and tariffs. Its competitive position, while undeniably strong today, is facing scrutiny on these critical, future-facing fronts.
So for you, the listener, whether you're an investor or just trying to understand this tech giant, these are the key areas to keep a close eye on moving forward. They link right back to those challenges. First, AI development and rollout. Will Apple deliver compelling AI features that really move the needle and silence the critics?
That's number one for sure.
Second, the iPhone 17 and beyond. Can future models sustain that growth momentum, or will we see that flattening or decline that some bears predict?
Crucial for the top line.
Third, tariff management. How effectively can Apple continue to navigate these pressures without hurting margins or pricing themselves out?
The constant balancing act.
And finally, services growth. Can that segment keep up its strong performance and play an even bigger role in driving revenue and profit long term?
Maintain that crucial diversification, yeah.
So monitoring those areas will be key to understanding where Apple heads next.
And all this raises, I think, a really important final question for you to consider. In a market often focused on immediate results, how much does the promise of future innovation or the shadow of persistent headwinds like tariffs truly dictate a company's perceived value? How long can a company's stock performance diverge from its own strong financial performance before something gives? It's a fascinating dynamic to watch.
A great thought to chew on indeed. Thank you for joining us on this deep dive into the complexities of Apple. We hope you feel much more informed about the forces shaping this tech titan. Until next time, keep exploring.
That's it from ValueBot Studios. Smart investing, simplified by AI. If this helped, follow, rate, and share with a fellow investor. The market moves fast. So do we. Subscribe now and stay ahead. Until next time, goodbye.